Hello everyone, welcome to our discussion of chapter 6, having to do with, and this is our last chapter in the textbook, having to do with operating budgets. So we did capital budgets in chapter 5. That's where we were looking at big items that are going to last a long time and developing the budget. And you notice that when we worked through those kind of scenarios, we looked at cash flows by year going forward, sometimes 5-7 years out. An operating budget is about day-to-day operations of the business, okay? And we're looking, typically breaking things down, at least in our examples, into months or quarters, but in real life, they can be as detailed as weekly budgets, daily even, in terms sometimes when you're really trying to find where your weak points are, that sort of thing. So that takes a lot of work, but it is the same process regardless of the time period. You're just going to include more things in your work depending on the time period. So as we look at what we're providing, this is a managerial accounting course. We are trying to help our managers have the information they need to make decisions. So one of their roles, as we introduced way back in the beginning of class, is to plan so that we can reach the goals on the path to success. So the company is trying to reach these goals, and a manager's job is to take that kind of pie in the sky, large, way out there kind of a goal and make it into a plan that people can execute on a day-to-day basis. And budgets are a way we take those goals and that plan and translate it into dollars, in cents, just probably dollars, but into the finances part of the business. How are the finances, how are the money and the resources that we need going to support our reaching our goals and our plan? And so while in many instances in real life the budget is a lot of math and a lot of spreadsheets and adding up and that type of thing, and sometimes we get caught up in all of that calculation, and we lose track of the real reason we do this is to translate our goals into a concrete dollar measure of how we're going to measure our success toward or our progress toward these goals. So we're going to use the budget to compare against actual performance after the fact. So we create the budget as a plan, and then after the plan has been executed, we compare our budget, what we thought was going to happen financially based on our plan, with what actually happened to see where we went well, things went well, where they didn't, what areas we might have of weakness that we could improve, that sort of thing. And we can then, that manager can use that to reflect on what they need to do better going forward, or what the business unit needs to do better. Okay? Now, in this process, if we're really going to come up with a plan and really make it execute well, we need the whole team involved, not just a single manager, not just an accountant, but all of those people who are part of the plan. If they have had input, if they have had a say into how we should spend our resources, then when they have a vested interest to make it work, if they were part of the plan, then they want it to succeed. And therefore, when you come back and say we didn't reach our plan in these areas, they are much more likely to be willing to help out and do better next time or make suggestions for improvement than if they were never part of the plan in the first place. Okay, so we want to get everybody on a plan that they can believe in. So The concept is referred to in textbooks and such as the master budget, although no one in real life uses this term anymore. They just call this the budget process. But these are the steps, if you will, of doing this budget or budget cycle, sometimes referred to. So we have to start with a sales budget. That is the key. That's where, without that, we have no way to know how much we need to do in production. We don't need it. Really, the whole rest of the thing is driven, whole rest of the process is driven by the sales budget. That tells us how much we think we're going to, and remember, we're projecting the future. So none of this is going to be exact, right? Sales budget drives our production budget, which includes how much direct materials we have to buy, how much direct labor we're going to have to use, how many people we're going to have working, and what we're going to have to spend on manufacturing overhead, those indirect costs that run our machines or make our building operate, all that kind of stuff. Then we have the selling administrative budget, those expenses that are going to show up on the income statement that maybe don't directly tie to our manufacturing but are still need to be paid, and therefore we need to have the resources to do that. And especially the selling budget is going to have a direct impact on our sales budget. So the selling budget is the costs to get sales. Sales is how much we actually think are going to get sold. All of that feeds into a budgeted income statement where we project revenues, we project expenses, cost of goods sold, get a operating income. Typically, we don't use taxes in a budget scenario because they are so much dependent on the tax rules and not on our performance. We then project cash flow, which is very important because we need to know that we have the cash to pay things. We need to see how the cash is coming in and going out. So it's not just a matter of getting profit or net income. It's also a matter of keeping enough cash in the bank so that we can meet our obligations. And then we kind of use the balance sheet to wrap things up and tell us if we got everything to balance. Even though technically that's not our focus in the sense of how much assets and liabilities we have. We're much more worried about or concerned about the projected income statement and cash flow than we are the projected balance sheet, except as a tool to make sure we didn't forget something. So, starting with that first one, the sales budget. It's so important. How do we do this? Well, this is also the budget that probably has the most uncertainty, right? Because we're talking about how much are we going to sell. And so we're going to want to talk to our marketing people. What are our customers saying? What are they facing? What kind of economic situation are our customers in? Are they doing well? Are they doing poorly? Are they and what are they thinking about the future? Are they going to be increasing orders, decreasing orders? Then we need to look at the economics. Is the economy going to turn around? Is it going to continue to lag behind? What kinds of interest rates are there going to be that drive new investment and new businesses in our industry? What is the industry as a whole? What's the trends? Are there new products? Is this a dying industry, an industry that is very competitive because there's not a lot of new companies, not a lot of new life? Or is it one that has a lot of innovation and we better keep up with that innovation or we're going to be left behind? Or those are the types of industry trends we might consider. So we're probably going to do our budget based on each product. If we make 10 or 15 different products, we will create a sales budget for each one, basically looking at how many units are going to be sold. This is volume. How many of those items? So if we're selling shoes, how many pairs of shoes are we going to sell of that particular product? And then we multiply that by the sales price. And the sales price is going to impact how many units we're going to sell, right? If we raise our price, if we consider raising our price, then there's theory that our sales in units will go down, maybe. If customers are unwilling to pay that additional price, there'll be at least some customers who say, no, that's too much for me. On the other hand, that may not happen as much as we think, or it may happen a lot. It may be, if it's a lot of competition, we raise our price a couple of dollars, and we'll lose a lot of customers because they'll go somewhere else. Okay, so we have to try to get a feel for how much that change in price might affect our units, because we're going to ultimately, the sales budget is going to have to look at how many units are going to be sold and what price we're going to be able to sell it for, those units for. So now that we have our sales budget and we know how many units we're going to sell by month or by quarter or by year or by week or whatever period we're using, time period we're using, we then take that sales budget and use it to build a production budget. So we are going to base our production to meet the sales that we projected in the sales budget. So if we project we're going to sell 100 units, then we need to obviously, in some way or another, produce those 100 units over whatever time period is needed for that sales. And we're going to see sales be up at certain times of the year, and so we may need to have additional production, and that's one of the things we want to do in breaking it down by time period, is to pick out those times where we're going to be extra busy producing these, so that we have on hand the resources we need for those extra busy times. Okay, so if we want to calculate the units to be produced, we need to take our expected sales in units. So far we're just talking about units, and add how many we want to have at the end of the accounting period, or whatever period we're looking, month, quarter, whatever. So we want to be able to sell this many, and we want to have this many left over, usually a percentage of the next month's sales. Okay, and then we subtract what we already have in beginning inventory. It's a new product, we wouldn't have it, we might have zero, but if it's an ongoing product, we subtract out what we already have produced. So you're adding together what you sell, what you want to have left over, and then subtracting what you have in beginning inventory. You usually do not want inventory to be zero, okay? Because unless we're on a true just-in-time inventory scenario, which is pretty hard to maintain. But absent that, we're going to want some leftover production. After we've sold a certain amount, our projected sales, we want some left over so that on day one of the new month, we have stuff to sell, right? And so we usually think of that, how much we want left over, as, like I said, a percentage of the next month, next quarter, next day sales, whatever period of time we're talking about. So the production budget is done entirely using units. And again, we would probably do it for each different product. A production budget for product A, product B, and so forth, just like we did the sales budget probably by our different product lines. Now, once we know how much we're going to produce, and then we have to have the materials, labor, and overhead to produce. So we don't have materials, labor, and overhead based on sales. We have materials, labor, and overhead based on production in units. Okay? From the production budget, since direct materials can have inventory, we're going to have to do a similar formula that we did to our production budget. We're going to calculate the units to be purchased by taking the units to be made, how many of the product we're making, times the units of materials in each unit of product. So if we're making jackets, and each jacket requires 3 yards of material, then we take the number of jackets we're going to make based on our production budget times 3. That's how many yards of material we need. Okay? So that's, then we add to that our desired ending inventory. So we want some fabric left over. We don't want to be at 0. And then subtract what we have in fabric now. So that tells you how many yards of fabric, in my example, that you would need to purchase. If you want to know the cost in dollars, you would take those units to be purchased and multiply by that price per unit. What does it cost to buy a yard of fabric? And that would tell you the total amount of money, which of course is going to be important later because we're going to need to know how much we need to spend for our cash budget in a later step. Right now we're focused more on the units, okay, of fabric that we need to purchase. Direct labor and manufacturing overhead is easier because you cannot store either one of those. You can't have extra like you can of fabric. You can't keep that, have a little extra at the end of the month for the following month. So direct labor is the units to be produced times the hours per unit of product. So we just need to know how many we're going to produce, right, from our production budget. And each one of them is going to require so many hours of direct labor, maybe an hour and a half, maybe 40 minutes, maybe 10 minutes, okay? And simply taking that number of units that we're going to produce times whatever the measure of minutes or hours or whatever to get how many hours of direct labor we need for that period, that month, that quarter, that year, whatever we're measuring. All right? Manufacturing overhead is also a planned amount per unit produced. We probably want to split out fixed and variable, right? Because we know that overhead can have both costs. We generally assume that direct materials are variable, direct labor is variable, but manufacturing overhead has variable pieces and fixed pieces. And so we might want to treat those separately because when we're trying to plan for the future, obviously from what we've learned about the behavior of costs, those that are variable are going to have a little different planning mechanism than those that are fixed. And so we might split those out. But we still need to look at it on a per unit basis. Okay, so that as we production. Now, fixed overhead isn't going to change with production, but variable overhead will. It should go up or down. And so our budget would be based on how many were produced. Not on how many sold, but on how many produced that particular time period.